Thanks for watching the Wall Street Wrap. Here's a look at what happened in the U.S. markets on Friday, December 3rd. U.S. stocks were in the red for most of the day on Friday, but markets turned green in the last hour of trade. Dragging stocks down during the day was an unexpectedly bad jobs report. Surprisingly, the U.S. economy only added 39,000 jobs in November, and the unemployment rate increased to 9.8%. Markets turned around at the end of the day as they focused on buying stocks that are considered a good bargain and also focused on what policies might be put in place to help the jobs market. It was a good week for the markets, with all three major indices ending higher over 2%. Stocks soared in the past 2 days over other positive economic indicators in real estate, retail sales, and the European Union stimulus plan of buying government bonds. In other economic news, a report showed factory orders fell almost 1% in October, dropping for the first time in 4 months after a 3% gain in September. Still, the drop was less than what economists had expected. Better news came in U.S. manufacturing activity, which rose slightly in November, surpassing predictions. And a fiscal commission ordered by President Obama, which put together a controversial plan to cut $4 trillion in debt, didn't receive the support it needed to present the plan to Congress for a legislative vote. In world markets, China announced it would pursue a more prudent monetary policy to help fight inflation, which was eased from tight to relatively loose in 2008 in order to combat the global financial crisis. Inflation hit a 25-month high in October of 4.4%, exceeding the government's target of 3%. Markets in Asia ended the day mixed. European indices ended the day mixed as well. And oil for January delivery rose to $88.82 a barrel after hitting a 2-year high of $88 on Thursday. Gold for February delivery rose 1.3% or $17.50. And the yield on the 10-year bond pushed down to 2.97% from 3% the previous day. And that's it for today. Thanks for watching.